I stopped doing stupid things. Everyone wants the secret, the magic shortcut, the one trick that will make them rich. There isn't one, there's only a list of dumb mistakes that smart people keep repeating generation after generation. Avoid them and you win. Simple as that. I've spent 6 decades watching clever people destroy themselves, not because they were unlucky, but because they couldn't stop making the same 7 errors. These 7 will cost you decades, not months, not years, decades of your life. And I'm giving you that list today. If you're making even 3 of them, you're already 10 years behind. So let's see which ones. This is the Munger method. No hype, no predictions, just what works when everything else fails. Let's begin. Mistake number 1, you're learning from your own mistakes instead of other people's. Wrong approach. Completely wrong. You don't live long enough to make them all yourself, and neither do I. So I learn from history, not from my own pain. I read obsessively, not motivation fluff, not get-rich-quick books. Failure stories. Every market crash, every fraud, every bankruptcy, every ruined genius, I studied them all. Why? Because human stupidity never expires. The same patterns, the same delusions, the same greed loops repeat every decade. Different actors, same play. You think you'll be the one who sells before the crash. You won't. Nobody ever does unless they've studied the fools who didn't. I've read about the South Sea Bubble, 1720. The crowd thought the laws of gravity didn't apply to them. They were wrong. I've read about tulip mania, the dot-com bubble, the housing bubble, cryptomania. Every time the same phrase, this time is different. It's never different. I wasn't alive in the Great Depression, but I studied every inch of it. People borrowed to buy stocks, got margin called, and lost everything. Lesson learned, never use leverage. If you can't afford to own it outright, you can't afford it at all. Tara, I read biographies, not for inspiration, but for cataloging mistakes. Carnegie, Rockefeller, Franklin, they all failed somewhere. Franklin invested in a ridiculous scheme that imploded. He wrote about it, so I didn't have to repeat it. And that's the point. They made the mistake once so you can skip it entirely. But what do? You lose money in crypto and act shocked like you're the first person to fall for a revolution. You buy a stock at the top, it crashes, and you're surprised. But it happened 1929, 1987, 2000, 2008. The data was there. Hundreds of books, thousands of case studies. You just didn't read them. Too busy scrolling videos about top 5 stocks to buy now. You'd rather watch hype than history. Here's the difference. Learning from other people's mistakes is not just cheaper, it's faster. I condensed 300 years of financial stupidity into a few years of reading. I didn't have to live through every crash. I just read about the ones who did. So here's your assignment. 1 failure story per month. Just 1. Read about pets.com, Webvan, Enron, Lehman Brothers. Long-term capital management. Nobel Prize winners, geniuses, wiped out in 4 years because their model said losses would only happen once every 1,000. Learn why. Learn how. Don't just memorize names. Understand the cause. How greed hides in logic, how optimism kills judgment. Each of these stories saves you a fortune. Boring, maybe, but losing everything is more boring. That's mistake number 1. Learn from the burned, not from your own blisters. Mistake number 2. Buying things you don't understand. This one drives me insane. My rule is simple. If I don't understand it, I don't buy it, period. No exceptions. Dow's obvious. But look around. You bought crypto in 2021 without knowing how blockchain works, how mining works, what proof of stake even means. You weren't investing, you were gambling with better marketing. And the irony, you'll spend an hour reading reviews for a $50 toaster, but throw $10,000 into a stock because some stranger on Reddit said, "to the moon." I've passed on thousands of investments that went on to skyrocket and I slept like a baby. Why? Because I'd rather miss a winner than lose on something I don't get. I skipped tech stocks in the 90s. People called me a dinosaur. You don't understand the internet, old man. Maybe. But I also didn't lose a dime when the bubble burst. I even passed on Amazon. Didn't make sense to me then. Did I miss out? Absolutely. But did I lose? No, and that's the entire point. When you only buy what you understand, you automatically avoid 90% of disasters. Sure, you'll miss some rocket ships, but you'll never crash into the mountain. That's the math that matters. So here's your test. Explaining your investment to a 10-year-old. I own part of a company that sells soda. People like soda. They buy it every day. The company makes money and shares some with me. That's Coca-Cola. Simple, understandable, profitable. Now try explaining this. I own a leveraged synthetic derivative tied to decentralized governance tokens. If you need a whiteboard, you're not investing, you're rehearsing jargon. Here's the second test. How does it make money? Not why the price might go up. That's speculation. I mean, how does the business generate cash? If you can't answer that one clean sentence, sell it right now, because the market will teach you that lesson the hard way and it charges full price. Mistake number 3, you're in a hurry. You want to get rich by Thursday. You think success should move at the speed of your Wi-Fi? It doesn't. I built my wealth over 60 years, not 6 months, not 6 years, 60. And still people ask me, what's the secret to getting rich quick? The answer is simple. There isn't one. That's the whole secret. There is no shortcut, no loophole, no hack, just time and compound interest. The most powerful force in finance is patience, and it's the one thing you refuse to practice. Everyone loves the idea of the next big thing, the next Tesla, the next Bitcoin, the next whatever. You're addicted to movement, not progress. You can't sit still. You need to trade, to buy, to sell, to feel like you're doing something. The irony is, the big money isn't in doing something. It's in doing nothing. Not in the buying, not in the selling, not in timing the market. It's in the waiting, the sitting, the discipline to watch everyone else panic or celebrate while you stay still. But you can't do that, can you? You see someone double their money in a meme stock and you panic. You start trading options, crypto, day trading on rumors and Reddit posts, chasing whatever ugly nonsense is trending this week. 5 years later, you've gone nowhere, worse than nowhere, because you paid fees, taxes, commissions, stress. Meanwhile, the boring person who bought an index fund and forgot about it is up 60, 70, 80%. He's not checking his phone every 5 minutes. He's not arguing with strangers online. He's sleeping peacefully because patience works and excitement doesn't. Here's the ugly truth. You don't need to hit home runs. You just need to avoid striking out. Base hits compound. Singles add up. But your ego doesn't want that. You want fireworks. You want to brag, to screenshot your gains, to tell your friends how smart you are. You want to sound like a genius, not a plotter. The problem is, the geniuses go broke. The plotters get rich. 20% a year sounds boring, right? It sounds slow, but do the math. 20% a year for 60 years turns $10,000 into over 500 million. That's not luck. That's conk interest, what Einstein called the eighth wonder of the world. And you're too impatient to let it work. You'd rather gamble than wait. You say you're investing, but if you can't leave it alone, you're not investing. You're speculating. You're feeding your dopamine, not your portfolio. You're looking for the emotional rush, not the financial result. I've watched people do this for decades. They buy high, they sell low, they repeat, and they call it a strategy. You want excitement? Go to Vegas. Investing should be boring. Here's your test. If your portfolio makes you feel thrilled, you're probably doing it wrong. If it makes you yawn, you're probably doing it right. Wealth grows quietly. Poverty screams loudly. And here's the kicker. 90% of active traders underperform the market over 10 years. 90%. These are professionals with PhDs, Bloomberg terminals, and caffeine addictions. They still lose to a simple index fund. So what chance do you have trading from your phone on your lunch break? You're not the exception, you're the rule. So stop. Stop trying to outsmart time. Stop chasing buy a low-cost index fund. Add to it regularly, then forget it. Check back in 20 or 30 years, you'll be rich. And everyone who laughed at you will still be chasing the next big thing. That's not boring. That's freedom. Mistake number 4, you think diversification means owning everything. This one's subtle but deadly. Wall Street loves to sell you on the idea of diversification. Don't put all your eggs in one basket, they say. Spread your risk, they say. So you buy 50 stocks, a handful of mutual funds, some crypto, some commodities, a few REITs, a sprinkle of gold, and you call it smart. It's not. It's confusion disguised as strategy. Diversification is protection against ignorance. That's what I said once, and I meant it. It makes sense for people who don't know what they're doing. If you actually understand investing, you don't need 50 positions. You need a handful, 6, maybe 10 at most, each one chosen carefully, studied deeply, understood completely. At one point, 90% of my net worth was in one company, Berkshire Hathaway. Was that reckless? No, it was informed conviction. I knew the business, I knew the people. I knew the odds. Concentration isn't dangerous when you understand what you own. Ignorance is. Now, I'm not saying you should put all your money in one stock. Unless your name is Buffett or Munger, you shouldn't. But owning too much is just as bad as owning too little. When you own 50 stocks, you've essentially recreated the market. You'll get average returns, but you'll also guarantee average understanding. You can't follow 50 companies closely. Nobody can. You don't have that kind of time. What you build isn't a portfolio. It's a museum of half-baked guesses, a do-it-yourself index fund with worse results and higher costs. You'd be better off buying Bond-Real Index Fund and using the rest of your time to live. The goal isn't to own everything, it's to own the right few things. 8 to 12 businesses you can explain, you can follow, you can believe in. Companies with real advantages, honest leadership, turnable cash flow. That's all you need. If you can identify 6 truly wonderful businesses in your lifetime, that's enough. 6, not 60. And if you don't have the time or interest to study individual businesses, then own an index fund. That's not failure, that's wisdom. Knowing what you don't know is beginning of intelligence. Pretending you know everything is how you go broke. So simplify, cut down your positions. If you own more than 20 individual stocks, you're over-diversified. Trim it to the ones you understand, the ones you could explain in a single sentence. I own it because it sells something people will still buy in 10 years. If you can't say that, sell it. The goal isn't to look smart. The goal is to get rich without doing stupid things.
Mistake number 5, you're hemorrhaging money on fees and taxes. You think you're compounding wealth, but what you're really compounding is expenses. Every trade, every hot tip, every new app or fund you chase takes a little slice. Individually, it feels small, a fraction of a percent here, a transaction fee there, but compounding works both ways. Just as small gains multiply into fortune, small leaks multiply into ruin.
You pay a 2% management fee because you like the fund manager's competence. You pay capital gains taxes every time you flip a stock. You pay advisory fees for people who aren't beating the index. You're feeding everyone except yourself. Wall Street calls it wealth management. I call it wealth transfer. From your pocket to theirs. The beauty of compounding only works when you leave it alone. But you can't. You keep stirring the pot. Every time you sell, the government takes its cut. Every time you buy, the brokers take theirs. And you wonder why your portfolio barely grows. You're busy watering weeds instead of letting the flowers bloom. Let me put it simply, compounding is like baking bread. It needs time and heat. Open the oven too often, and it collapses. That's what most investors do. They open the oven every week, checking, poking, selling, buying, ruining the rise. The people who get rich are the ones who stay out of the kitchen. And those active managers, the ones charging you 2% to beat the market. Most don't. Over 15 years, more than 90% of them underperform simple index funds. They lose money and still send you a bill. Imagine hiring a doctor who makes you sicker but still charges you premium rates. You'd fire him immediately. But when it's money, you make excuses. The market was tough. No, the management was bad. The solution? Keep costs microscopic. I mean almost invisible. Index funds, low turnover, long holding periods. Every dollar you don't pay in fees compounds for you, not against you. Warren and I used to joke, the surest way to get rich is to be the guy collecting fees, not the one paying them. Don't be the one funding someone else's yacht. Taxes too. The market rewards the patient with tax efficiency. Every time you sell, you trigger a tax event. Short-term gains get punished. Long-term holdings get rewarded. So hold through boredom. Hold through noise. Hold until your investments turn from speculation into ownership. The best tax strategy isn't fancy, it's inactivity. And don't mistake complexity for intelligence. The more complicated your investment structure, the more people there are between you and your money, each one taking a cut, smiling, shaking your hand, thanking you for your trust. Keep it simple. Own assets directly. No layers, no gimmicks, no unnecessary middlemen. That's mistake number 5. You don't need to outsmart the market. You just need to stop letting everyone else feed off you. Mistake number 6. You're surrounding yourself with the wrong people. You think your environment doesn't matter. It does. More than you realize. Your friends, your coworkers, your mentors, they're shaping your behavior every day. You pick up their habits, their assumptions, their fears. You become a reflection of your circle. If you spend your time with gamblers, you'll gamble. If you spend it with dreamers, you'll dream. But if you spend it with rational thinkers, people who measure, analyze, weight, you'll start doing the same. We all imitate the tribe we belong to. Whether we admit it or not, that's why Buffett and I were lucky. We each found the right partner. Someone who could tell us you're wrong, without fear or ego. Someone who forced us to think harder, not faster. Look around you. Who's influencing your decisions? Are they calm, informed, deliberate, or emotional, reactive, and loud? Do they read books or tweets? Do they talk about principles or trends? Most people are victims of secondhand stupidity. They absorb it from the crowd, from social media, from the noise of people who've never succeeded at anything real, and then they copy it, thinking it's wisdom. You can't build a rational life in an irrational environment, so build your own environment. Curate your circle. Seek people who make you think, not people who make you feel clever. Find someone who challenges you. Disagreement sharpens judgment. Flattery dulls it. There's an old saying, if you're the smartest person in the room, you're in the wrong room. That's true, but here's what people forget. If you're the richest in the room, that's fine, as long as everyone else is smarter. I'd rather learn than brag. The world punishes arrogance. It rewards humility and curiosity. Don't let envy infect your judgment. Envy is the tax you pay for watching others too closely. You see someone win, and instead of learning, you resent. You copy without understanding. You imitate tests instead of studying it. That's poison. Envy turns intelligence into blindness. So guard your mind like you guard your money. Be selective. Be deliberate. Don't spend time with people who confuse noise for insight. The people around you are like the stocks in your portfolio. They either compound your wisdom or drain it. Choose carefully. And remember this, you can't soar with eagles if you keep scratching with chickens. Mistake number 7, you think happiness comes after success. It doesn't. It comes before. You imagine a future version of yourself, richer, freer, calmer, but that person doesn't exist. The habits that make you miserable now won't disappear when you have more money. They'll scale it. You'll still worry, still compare, still feel empty. Wealth amplifies character. It doesn't change it. If you're anxious now, you'll be anxious with $1 million. If you're disciplined now, you'll be disciplined with 10. Mistake number 7, you think happiness comes after success. It doesn't. It comes before. You've been told your entire life that once you make it, once you hit that number, buy that house, or build that company, you'll finally be happy. That's the lie. You don't reach happiness through success. You reach success through happiness, or more precisely through stability, discipline, and peace of mind. People think money will make them calm. But calm people are the ones who make money. They can think clear when everyone else is panicking. They can hold when everyone else is selling. They can stay patient when everyone else is chasing. Happiness isn't a result, it's a competitive advantage. It's emotional control. You can't make good decisions in chaos. You can't invest rationally when you're driven by fear or anger or envy. So what happens? You chase highs and avoid boredom. You trade because you're restless. You spend because you're insecure. You fill your life with noise because silence feels like failure. But silence is where the real growth happens. I've seen billionaires miserable beyond belief, addicted to competition, status, and comparison, always asking, who's richer, who's faster, who's ahead? They never stop to ask, am I content? Because that question terrifies them. They built a machine that only runs on dissatisfaction. And when it stops, they don't know who they are anymore. Charlie Munger said it best. To get what you want, you have to deserve what you want. That means becoming the kind of person who could handle success without being destroyed by it. The irony is that the calmer you are, the more money you make, and the more desperate you are, the faster it slips through your hands. Here's a thought experiment. Imagine you wake up tomorrow with every dollar you ever wanted, no debts, no worries. Now what? Would you know what to do with your time? Would you know who to be without the chase? Most people wouldn't. They've built an identity around struggle, not around purpose. They need chaos to feel alive. But freedom isn't the absence of struggle, it's the mastery of it. Money solves money problems. That's it. It doesn't fix your marriage. It doesn't erase your regrets. It doesn't give you meaning. It just amplifies what's already there. If you're real, you'll be more grateful. If you're bitter, you'll be more bitter. That's why gratitude is the foundation of every rational investor's mindset. It keeps you anchored. You can't compound happiness later. It compounds now with small habits. Reading daily, thinking slowly, saying no more often, choosing calm over chaos. You can't wait until you're successful to build those habits. You have to build them now while you're still climbing, because once you reach the top, you'll need them even more. Here's something most people miss. Contentment is not complacency. It doesn't mean you stop improving. It means you stop comparing. It means you focus on your process, your pace, your plan. You can be ambitious and peaceful at the same time. In fact, that's the only way ambition lasts. Constant urgency burns out even the brightest minds. I learned that lesson the hard way. There were years when I obsessed over numbers, portfolio performance, net worth rankings. Every quarter I wanted more. But eventually I realized enough is the number you decide, not the one the market dictates. Enough isn't a limit. It's a defense mechanism against insanity. You can't win a game with no finish line. That's what endless comparison is. A game with no end. You'll run until your knees give out and your heart stops, and still you'll never feel ahead. Stop playing. Decide your own finish line. Write it down, define enough, and defend it. Because here's the quiet truth. Wealth is just a tool. The real goal is autonomy. Freedom from needing to impress, from needing to perform, from needing constant validation. The freedom to think slowly, to choose wisely, to act deliberately. That's what happiness really is. Control over your time and your emotions. If you want to be rich, build systems. If you want to be free, build discipline. If you want to be happy, build peace. And if you want all three, understand that they're the same thing seen from different angles. So no, happiness doesn't come after success. It's a soil success grows from. Without it, you'll build an empire of anxiety. With it, you'll build a life that lasts. And that brings us to the truth. Most people never learn the difference between success and fulfillment, the sustainability. Success is external. The world claps for you. Fulfillment is internal. You clap for yourself. The first fades. The second compounds. If you can build wealth, patience, humility, and gratitude all at once, you've solved the puzzle. You've cracked the Munger method, because all 7 mistakes are really just one lesson. Avoid stupidity, let enough, and wisdom takes care of the rest. But we're not done yet, because the most powerful ideas don't live in theories, they live in practice. The next part isn't about what to avoid. It's about what to build, how to think, act, and invest like someone who has already escaped the noise. The next part is the blueprint.